Welcome to The Explainer. So today we're diving into an absolute epic showdown that honestly has the financial world completely split right down the middle. On one hand, you've got the super intoxicating allure of hyped up, explosive tech growth, and on the other, the tried and true promise of long-term, rock-solid stability. If you're serious about optimizing your investments and you want to know exactly how to structure your portfolio for the future, well, you're definitely in the right place. We're going to break down the hard data, the AI simulations, and the real-world strategies behind two of the most talked about index funds out there today. Let's get into it.
Now, you might be wondering, why is there this massive, super controversial narrative going around the internet right now? Seriously, everywhere you look on financial forums, people are saying you should completely avoid the hugely popular iFreeNEXT FANG Plus Index. You'll see these flashy articles practically screaming at you to stop, or warning that it's just too dangerous. But hey, as focus learners, we don't just blindly accept headlines, right? We need to look directly at the source material to figure out exactly why this fund has such a polarizing reputation, and more importantly, whether that reputation is actually deserved.
All right, part one, the true nature of FANG Plus. To really get why people are freaking out, we have to look under the hood and see exactly what this fund is made of. The FANG Plus Index isn't your standard run-of-the-mill mutual fund, not even close. It has a very unique structural rule, and the core of its risk literally comes down to just one number, 10. Yeah, exactly 10. That's the total number of companies in this entire index. While traditional global funds spread your money across thousands of companies to keep you safe, the FANG Plus Index is hyper-concentrated in just 10 major U.S. tech giants. We're talking about the absolute titans here. Meta, Amazon, Netflix, Apple, Alphabet, Microsoft, and NVIDIA, plus a few others. So when you invest in this, you are 100% at the mercy of the U.S. tech sector. If those 10 companies thrive, you soar. But if tech faces headwinds like high interest rates or strict new regulations, well, your entire investment takes the hit. But here's where it gets kind of crazy, how the money is actually distributed among those 10 companies. The FANG Plus Index uses something called an equal weight average. Now, traditional funds usually use a market cap weighting, which is just a fancy way of saying the biggest companies get the most of your money. But FANG Plus, it divides its funding completely equally. This means every single one of those 10 tech stocks has the exact same impact on the fund's overall performance. It's a real double-edged sword. A massive win for a smaller company in the index boosts you just as much as Apple having a good quarter. But on the flip side, a scandal or an earnings miss by just one of the 10 will instantly drag the whole entire fund down. Moving on to part two, a deep comparison of FANG Plus versus the S&P 500. To truly grasp the mathematical reality behind all this controversy, we've got to strip away the hype and look strictly at the mechanics. Let's do a head-to-head. On one side, FANG Plus holds just 10 stocks, completely laser-focused on U.S. tech. On the other side, you've got the S&P 500, spreading your risk across 500 companies spanning the entire broad U.S. market. But you know what? The absolute most critical difference here might actually be the trust fee. That's the annual cost you pay the managers. The S&P 500 charges an ultra-low fee, usually well under 0.1%. FANG Plus, though, it charges a staggering 0.77%. In the world of index investing, that is a massive premium. And as we're about to see, that little percentage difference has some profound long-term consequences.
So the source material actually details a really fascinating simulation run through Gemini 2.0 and ChatGPT to see how these funds perform over a lifetime. They simulated investing 20,000 yen every single month over a 50-year period. And the results? Well, because of the S&P 500's significantly lower fees, the magic of compounding interest allowed it to ultimately win out as the clear mathematical victor for long-term retirement stability. Don't get me wrong, FANG Plus absolutely demonstrated explosive short-term growth potential, and historically there have been periods where it totally crushed the S&P 500's returns. But over half a century, those high fees on FANG Plus act like an anchor, dragging down the compounding effect, making the broad, cheap S&P 500 the undisputed champ for your retirement account.
Which brings us to part three, the ultimate combination strategy. You know, the really good news here is that this isn't an either-or scenario. You don't actually have to pick just one. The secret lies in something called the core satellite strategy. Think of your investment portfolio like a perfectly balanced meal. Your core should be about 85% of your portfolio. This is your main dish, providing sustenance and stability. It should consist of broad, widely diversified funds like the S&P 500 or an all-country global fund. Then you have your satellite, making up maybe 15%. This is the FANG Plus Index. Think of it as the spice. A little bit of spice dramatically enhances the flavor of the whole meal and boosts your overall growth potential. But if you try to make a whole meal entirely out of spice, yeah, that's going to be a painful disaster.
But a quick warning here. If you're going to mix these, you absolutely must understand how they interact. If your main dish is the S&P 500 and you add FANG Plus as your spice, you're actually creating a super heavy overlap. The S&P 500 is already heavily weighted toward the exact same US tech giants that make up FANG Plus. So you aren't really diversifying, you're just doubling down on American tech. However, if your core is an all-country global fund which spreads your money across the entire world, including emerging markets in Europe, then adding FANG Plus provides a much safer, truly diversified global baseline while still letting you capture that aggressive tech growth. All right, our final section, Part 4, Rules of Engagement and Crash Survival. Listen, if you are going to add this high-risk spice into your portfolio, especially in tax-advantaged accounts like Japan's NISA program, you've got to have a strict framework. The source material outlines 3 absolutely critical rules. Rule 1, adjust your risk based on your age and your timeline. If you're in your 20s or 30s with decades to recover from a market crash, sure, you might allocate 15 to 25% to FANG Plus. But if you're in your 50s and nearing retirement, you should definitely dial that spice way back to like 5 or 10%. Rule 2, assess your total tech risk. Take a look at your whole portfolio. Do you already own individual Apple or Nvidia stock? If you do, adding FANG Plus might push your tech exposure right into the danger zone. And Rule 3, rebalance annually. If tech has a massive year, your 15% spice might accidentally grow into 30% of your portfolio. You've got to lock in those gains by selling high and buying your core funds low so you can maintain your original target ratio. Now, what happens when the tech sector inevitably takes a hit? Because with that intense concentration of just 10 stocks, you are going to experience some wild swings. The sources outline 2 vital steps for crash survival. Step 1, do not panic sell. Selling during a crash just turns a temporary paper loss into a permanent, very real loss. Step 2, keep up your monthly investments. This is the absolute magic of dollar cost averaging. When the market tanks, your monthly contribution is suddenly buying a lot more shares of the fund at a massive discount, which totally sets you up for a much larger recovery when the market inevitably bounces back. So we've broken down the intense risks of FANG Plus, its hefty fees, its massive growth potential, and exactly how it compares mathematically to the S&P 500. We've seen that the smartest path forward isn't choosing just one, but combining them intelligently into a balanced financial meal. Which leaves us with the absolute most important question for you to take away from this explainer today. Does your portfolio currently have too much spice? Take some time today to really review your allocations and make sure you're positioned not just for short-term excitement, but for lasting, long-term financial success. Thanks so much for learning with us today.